In 2025, U.S. markets posted double-digit gains. AI winners emerged, international stock outperformed U.S. stock, and retail investors flocked to metals and tech. Today, we break down the numbers, trends, strategies every investor should know in the new year.
Welcome to a Wiser Retirement Podcast, where we cut through the noise and bring you real, honest conversations about investing, retirement, and building lasting wealth. No sales pitches, no gimmicks, just everything your financial advisor won't tell you.
I'm Casey Smith. Today, I'm joined with Shauna Theriault, Senior Financial Advisor, and Andrew Pratt, our Investment Manager, who I call the King of Data. Hello, everybody.
Hello. Happy New Year.
So today, we're going to break down what actually drove 2025 returns and what may or may not repeat in 2026. So Andrew, what drove returns in 2025? Let's focus on the U.S. market first.
The stock market was up 18%. Doesn't really feel like 18%. I think partly because it was so volatile throughout the year. But really what was behind that return is we had a lot of earnings growth, which is, great for market returns. But there's also a portion of that was from multiple expansion and then dividends. But overall, is what we want to see for price appreciation in the U.S. stock market is from earnings growth.
Because that's a solid return then. That's legitimate, right?
Yeah.
So,
that just means, companies are continuing to grow their earnings and those valuations are justified. But really and I saw a quote. So I believe the top 7 stocks drove 60% of the return in the U.S. market and also, but accounted for 60% of the earnings growth. It's not shocking that the Mag 7, mostly accounted for a lot of this, return. I think it's been a concern for a while for most people, the concentration risk. I would say kind of just to counter that again is as long as earnings continue to grow and these companies are growing in their valuations, I'm not really that concerned because actually, I was looking at the forward valuation multiple, and that's just looking at today's price over forward expectations. We are actually a lot cheaper than we are today than we were a year ago.
Interesting.
I think I saw it was 22 time forward multiple versus 28 of early last year.
Well, see, and so people think there's a bubble.
Yes.
We were there in the tech bubble.
Yeah.
But if the forward looking returns are there and look good, then it doesn't look expensive. That's a bubble. Something that looks overpriced is a bubble. So it's not looking like that, right?
No. And going back, and people always kind of equate it to the .com bubble. There was no earnings, no cash flow at all. It's just kind of pure speculation.
Yeah.
That's not happening now.
Yeah.
It's, real cash flow, real earnings, real investment. This time is definitely, I hate to say different, but it is.
Yeah. Yeah.
But kind of expanding on that too is, and this was, I thought, pretty interesting stat is, so out of 14% out of that 18% came from earnings growth. So 3/4 of that came from sales growth, and then about 1/3 of that or 1/4 of that came from margin expansion. It was pretty pretty crazy to think that companies were able to expand their margins with all this macro headwind, with tariffs, cutting costs, probably a little bit weaker consumer. So just the fact that they were able to boost margins in this environment is incredible. So that was, I think, a good sign as well.
So when we think about this argument that the market's overvalued, what you're saying is that's not necessarily true because we have earnings. But when we talk about, hey, your S&P 500 allocation has really just 7 stocks that are controlling it, is that a fair statement? Or what happened to the other 493 stocks throughout the year?
Yeah, I would say they're the ones dominating. The 493, they performed well, but not as quite as well as the Mag 7 or tech stocks. But I think there's a lot of expectation that these could, and I thought we would see a little bit more of this in Q4. But the other, I guess large cap stocks and mid cap and small cap stocks, they will do better when in a lower interest rate environment. So I think, kind of looking forward, that's something we can expect. I mean, that's also why we have in the portfolio. Again, it's hard to time these outperformance trends, and you want to make sure you have exposures to those areas, though.
So let's shift gears a bit. Let's talk about international markets. Uh, for the last decade, we've been told that international is the place to be. It's not the US. And that's been a really wrong
Mhm.
bet up until 2025. So in 2025, what are we seeing that's driving these developed markets to have a higher rate of returns than the US markets?
Yeah, international and emerging, they both. I think international is about, give or take what index you want to pick, 32 to 35%. Same with emerging market major indexes out there. Again, that's about 8 to 12+ percentage outperformance versus US. I was looking back just at some data points of calendar returns over the last 16 years. Internationals outperformed the US only 4 out of those 16 years. So again, you want to have exposure there, because you can't time these outperformance trends. But over long term, doesn't make sense to really be overweight this one area and return chase, in my opinion. So again, that is something I'm kind of looking into. Is this a paradigm shift, a longer term trend? I don't believe it is. I wrote a blog about this a couple months ago. The international, you just like look at return based on sources. Um, Majority, across all countries and geographies, for the most part, a lot of this return came from currency appreciation relative to the US dollar. So that's not really a sustainable source of return. And what I mean by sustainable is, again, going back to earnings growth, that's a sustainable source of return. So international, right now, we are not really seeing that. They're not really having the earnings growth. It's all coming from the US dollar weakening. And so again, it's something, I think it's important to watch. But again, I don't think we should jump, at first blush just to overweight international because of that.
Yeah, and I often tell clients that that's the reason why we have international in the
Yeah,
portfolio.
exactly.
Really is for currency hedge, and it's doing its job.
Right. Mhm.
Certainly, if you look at a benchmark like the ACWI, which is the entire world,
Mhm.
it's outperforming some of our model portfolios just because it's so heavily weighted to international
Mhm.
stock.
Right.
If you look back over the past the 1 year span, then
It's
it
not.
kind of switches, right?
Yeah.
Right.
So you have to be very careful that you don't return chase.
Mhm.
And also too, I feel like over the last 2 years, especially, a lot of politics has gotten into financial news cycles,
Right.
and a lot of people are fearful of um, who the president is, and then that translates
Mhm.
into I have to be less risky in my portfolio, and there's actually not much correlation between the
Right.
two. There is maybe through a day or two news cycle potentially. We saw that with tariffs at the beginning of the year, which actually created a great rebalancing opportunity, which you did in the portfolios. But people make the detrimental moves in their portfolios because of the intertwining politics and money, and it doesn't really there's no data that
Mhm.
supports that these two things are long-term correlated with each other.
Yeah, and I think, at the end of the day, the US dollar is gonna remain the global reserve currency, the most liquid and largest bond market. I think it's 2 times the bond market of China. And also, are you gonna really go to China, to are investors gonna, buy Chinese bonds? I
No.
don't think so. But I think, eventually everything flows towards quality growth. And I think right now that's still a true story for the AI and tech companies in the US. And there might be some underappreciated companies like in China, that aren't really seeing a bid yet. But again, I think right now that's the growth story globally.
So in 2022, bonds got kind of flipped on their head. We had
Mhm.
double down year. The stocks were down and bonds were down. Bonds have steadily started recovering from that. What was our outlook in fixed income for 2025?
Yeah, so 2025, our expectation was that the Fed would cut rates 3 to 5 times. That was a little rosy. They actually ended up cutting rates 3 times starting in September, and the last cut was in December. So we had positioned our bond portfolios to be sort of in line with the broad US bond markets, duration, and that's just really like the average maturity in the bond portfolio. And our bond portfolio's duration is around, about 5 years. And when you have a little bit longer duration, when interest rates are reduced, that actually um, correlates to higher price appreciation bonds because you have a bond that's yielding that has a higher yield, and because it has a lower interest rate, it's deemed more conservative or safer. So
So
um,
just to interject here, so for listeners who don't remember this from their finance class, basically when there's an inverse, it's like a seesaw, picture a seesaw. So if interest rates drop, bond prices go up. If interest rates go up, bond
right,
prices come down. So
yeah,
in 2022, we had this rapid increase in interest
yes,
rates, which caused bond prices to rapidly fall. Since then, rates have been coming down
mm,
steadily, and so prices are now going back up. The yield in your bond doesn't change unless you're buying something
right,
new,
right,
but
yeah.
the value of your bond had gone up. But do you remember what the aggregate was up for the year? I don't know if I have that
Yeah,
data here in front
it
of
was
me.
up about a little bit over 7%.
7%
Yeah.
gain in bonds this
And
year.
then one of our core position funds was up about 8%.
Yeah, yeah. Okay. So what are your projections for this next 12 months when it comes to bonds specifically?
So I think one of the main indicators, and some clients have asked me about this, is something I look at periodically is just corporate credit spreads. I think that's one indicator out of many that you can look at to see, are there any cracks in the underlying economy. Right now, those spreads are still very low, and they're still kind of grinding down. And what I mean a spread is what a corporate bond is trading versus like a U.S. Treasury, like a risk-free asset. So to me, there's no warning signs there. But yeah, I will say these spreads have pretty much grinding down to all-time lows. So the spread's very narrow.
Meaning
So
it's going to return similar to a risk free is what you're
well,
saying.
yeah,
Or you might as well be in the risk free because you're not getting that much better of a
mhm.
yield than being more riskier in a corporate.
Yeah, and I guess another way to say it is it's just more expensive. It's kind of like a valuation metric. It's
Got
just
it.
like there's not like a ton of like blaring opportunities, but still, it's like high quality corporate bonds um, are still from a risk concern. There's still there's no concern there.
Well, and this is what, we always want to drive home with clients and with listeners. Your bonds are your safety, they're your downside protection potentially. And so when we're looking at how do you construct a portfolio, especially in retirement or getting near to retirement, you want to have, your cash bucket, fixed income, and then your long-term growth. And so the fixed income, we don't want to take huge risk with that because we want it to be there for spending. If the market goes down, you have your cash bucket and then you can dip into the fixed income if it's, it was longer than a 2-year recovery. So that is really the hedge and the downside protection and the safety that for your spending while you're in retirement. So you want that balance. So you don't want to have something that's hugely risky with those assets.
Right.
So let's shift gears back a little bit. I got ahead of us on the agenda here, but let's talk about commodities and alternatives in 2025. This gold does nothing for a long time, and then it
Right.
does something. So there was a 64% increase in gold alone in
Right.
2025. Is that a fear trade? Is that the interest rates dropping, the value of the dollar dropping? Is that
I think it's a combination of both. I think it's going back to um, and there's just concerns with currency and fiat globally, and a lot with the US dollar. US dollar, I think, had strengthened to one of its highest relative levels to like the euro
Mhm.
in the past 40 years, maybe. So I think a lot of it, some of it's mean regression to a long term average, but also just printing money. I think investors see how currency can be debased, and people are going to other alternatives, like precious metals, gold and silver.
Mhm.
But also there are some supply and demand shocks with silver. I know that silver is used in like solar panels and other AI technologies, and I think China came out with some sort of regulatory restriction recently. So I think to me, it's sort of more of a FOMO. We were just looking at it before the podcast started. Gold is up 300% in the past 10 years. And so 64 of that percent is
Was
part
it
of that,
1 year? Yeah.
part of that 300%. So
Mhm.
Silver up as well.
yeah,
We don't have Bitcoin over here, but
yeah,
it was it down for
it
the
was
year?
down like 6%, and
Yeah.
but already it's up 6% starting or more starting this year. So it's already taking back
Yeah.
some
In
of those gains.
26.
Yeah,
Yeah.
26.
And you
Uh,
looked at it beforehand. You and I were looking at that. What has Bitcoin's return been for the last 10 years relative to?
So Bitcoin's return, I think it was like maybe closer to 21,000%.
Yeah.
And that's why,
Versus gold, but obviously it's a new
yeah,
asset class too.
yes,
So it's it's not, you can't
that's not
compare the
quite
two.
fair. That's
What
not quite fair
it's
comparison.
not fair, but it's people do get caught up in are, I hate to say return chase, but when there are strong returns, people need to zoom out a little bit and just sort of think about the overall picture. Like, is this sustainable in the long term?
Right.
And I think gold probably does have some more legs to run a little bit. But also too, I see we do like digital assets and Bitcoin over gold for various reasons. And I think that's the way of the future as well.
As a small percentage of the portfolio.
Yes, small percentage of portfolio. And so we rather get our, Bitcoin is a currency debasement hedge. One of the attributes we like about it, but we rather get it from there versus gold. And that's kind of like how we're positioning our portfolios.
When you have gains out of gold like this past year, we get a lot of questions. Why don't we own gold in portfolios?
Mhm.
Do you want to address that?
Gold is not cash flow based. It is, I hate to say speculative. It is more speculative. And someone could argue the same with Bitcoin, but we like Bitcoin more just again for like the future. It is truly a cap supply. Store value, it's just faster technology, with transaction speeds, no storage costs, divisibility, et cetera. So that's the reason why we consider Bitcoin as a small piece of the portfolio. But gold, again, it's more speculative. It's not cash flow based. It's just hard to put a fundamental value on it. And it's more just kind of a FOMO trade, in my opinion. And people always say it's an inflation hedge. It really hasn't, maybe up until this past year, it really hasn't hedged inflation.
In 2022, it didn't hedge anything.
Right.
In 22.
Well, an inflation hedge is also owning stocks, because if the prices of creating a widget go up, then they pass it through the consumer. Yeah. So that's also an inflation hedge.
We have inflation hedges elsewhere in the portfolio. And, one other thing too with gold, and I'm not trying to hammer down on gold, but it increases its supply globally about 2% a year. So there's concerns about validity of the actual gold. There's so the supply, there's limited number of resources of gold. I don't think we know exactly how much that is. So
yeah.
Okay, so let's talk about some themes that took place in 2025. When you think about themes in the past, you've had wartime, you've had a stock bubble burst, you had Enron, you've had all kinds of themes that have taken different, the financial crisis each year. What are some, let's say maybe three themes that you see this year or last year that took place?
So I would say kind of the AI, and we sort of already alluded to this, but the AI growth kind of expanding throughout smaller mid cap, kind of going down market cap, as you would say. So I think that's one thing that we'll start to see. Whether that, I don't think that will necessarily outperformance per se, but I think more companies besides the top 7 will benefit from that. I think another theme too, kind of adjacent to AI, is some of these power and utility companies, although some had really strong returns in 2025, I think that will become more of a theme, is like the nuclear and some of these more maybe real estate oriented, like data center type companies are going to just continue to see adoption and investment there. I also think, again, with fixed income, right now the market's expecting 3 more cuts in 2025 or 2026. I think, we'll probably be close to that. So I think, again, it's just kind of more, just sort of intermediate bonds still continue to do well in 2026.
What about another theme?
Valuation is a concern. Again, if earnings growth doesn't keep up, from a lot of stuff I've been reading and just listening to on podcasts, is I think we're going to continue to see more margin expansion. And I don't think corporate CEOs are explicitly saying this, that they're probably freezing hiring or cutting hiring, but I think they're going to be doing that and then using AI to sort of boost profitability. So they're not really coming out and saying it, because I don't think that's really a good thing or publicly to say. But I think we'll continue to see margins expand, and that should just sort of help that higher valuation across the market.
Yeah, and then I could think another theme that I might add would be investor behavior. So we saw a lot of strong inflows into tech ETFs, AI funds, gold, obviously silver. Silver is up 145%. I don't think we talked about that. That's a big move for silver.
Yeah, and I think it was down like 8%. I mean, it's been very volatile. It's like almost like a meme stock or something.
Right.
It was like that. I think 8% like a couple of days ago.
So yeah, I think those were kind of the major themes. Obviously, Trump's presidency took a lot of the headlines and tariffs. We still haven't seen. Academia tells us that tariffs are just going to totally tank the economy, and there really hasn't been any indication of that. In fact, inflation is lower than it was a year ago. So that it just theoretically we should see a small bump in inflation. I think we've seen that bump in inflation, right, and that should be about it.
Yeah, I think Goldman Sachs has a chart that shows they expect the one-time increase from tariffs should be fully out of the equation by like I think Q1, Q2 this year.
Yeah.
Before we jump back into the episode, do you know if you are ready to take off and launch into retirement? Get your pre-retirement checklist, a free guide from Wiser Wealth Management. From cash flow to Social Security, we've got your countdown covered. Go to wiserinvestor.com/guides to download your free guide today. Now let's get back to the episode.
All right, so let's talk about entering 2026. So kind of give me an economic backdrop. Like if I was looking at a status board right now, what am I? Am I all green for 26? Do I have some yellow? Do I have some red? Like how should I be looking at this as we enter in this new year?
So I think equities, from what I've seen right now, all the sophisticated, most intelligent Wall Street analysts are expecting about a 9% median return projection from where we are right now. And that's price return. So I guess about 9 to 11% total return. I think, I definitely believe that's a possibility. Again, as long as earnings growth continues to keep up pace. Something I think that's worth noting is entering a midterm years are the most volatile, and usually the worst performing years out of a 4-year cycle. So that's something to keep note of. I think we got a good taste of volatility last year. Yeah. It was probably one of the more volatile years that we've had in the past 5 years. So again, I think there's just more volatility, especially with who's sitting in the Oval Office, and I think obviously more just putting policies out there. So my expectation again is I think U.S. equity. I believe international could probably still outperform for a quarter or two. I think that's going to start to sort of normalize though later this year. So we'll see how that plays out. But again, across the board, equities will be positive. I think again, kind of sort of status quo. Bonds will, U.S. bonds will perform well. I think international bonds will continue to perform well. Unhedged currency. So our international bond actually is hedged. So typically you want to have your international bond currency exposure hedged because it's very volatile. And to be in a bond portfolio, you just, that's not what the role of bonds are. Bonds are for capital preservation, and so you don't want the currency volatility, but so I think international bonds that are unhedged will probably outperform. And then GDP growth. So actually Q3 was the highest that we've had in 2 years, at 4.3%. all the expectations are that it's going to trend down to kind of the more terminal 2.2% or so. I think we'll actually kind of track above that in Q4. We do have a government shutdown that could potentially happen again in late January. So, if Congress can get their act together, unlike this past fall, hopefully that will.
That didn't really seem to affect the markets much, though.
We had some big pullbacks in
Did we?
October and November. Yeah,
okay. Just over the shutdown.
It probably didn't feel the same as it did in the beginning of the year, because
I was about to say
that kind of overshadowed it a little bit. I think
most shutdowns, it really doesn't affect markets, but then when it was starting to get pushed out, and then like
near the end,
going to like
your traffic controller,
like stuff like that.
Yeah, that's true. I forgot about that.
Impacting the economy. Yeah. I think that's when the market started to get spooked a little bit.
So yeah, that's true. What do you see about corporate earnings? Do you think there's a big spike? I mean, you keep saying the margins will get better. I mean, they have to get better if we're expecting a 7 to 12% return of stocks. I mean, we have to support that with earnings.
Yeah, I think they'll get better, and I think also as interest rates come down on the lower end, it just will help the smaller cap companies too, just from the borrowing standpoint. They're very sensitive to borrowing costs and just for financing their growth and innovation. So I think again, I do think probably smaller caps have a chance to outperform. Again, that's like calling international outperforming U.S. stocks. You just don't know when it's going to happen. But
so Andrew, where do you think AI takes us in 2026? Is it still going to be the Mag 7 leading the pack, and we get most of our return from those stocks?
I believe so. I saw something that only 2 of the Mag 7 outperformed the S&P 500, and again, a lot of it was just kind of valuation compression. Again, these companies, I think Nvidia was up 40+%, give or take. But I think people don't really realize that the S&P 500 still outperformed a lot of these companies, and just what we've seen with earnings growth and profitability, I think this continues. And again, there's real investment here, and I can't remember the exact number. I saw something like in the third quarter, it was like the most capital or CapEx investment from these companies in a long time. So again, this has legs. So I do think that they're going to outperform.
Yeah, and also too, I know what we spend in using AI to make us more efficient has really increased. I have a line item for that, where a couple of years ago I didn't have a line item for that. But if you remember back in the tech age, Amazon.com was a tech company, right? And now it's a retail company. And so as this stuff filters through, we'll see AI companies that now, if you're making hardware, you're still making hardware, but AI companies will be software companies, or they'll be accounting companies, not AI companies, right? So it'll take a few years for that to kind of cycle through. But this is the new way of conducting business, and it's definitely here to stay, and it's profitable.
Yeah, and I think just even partnering with like blockchain, like because not necessarily for healthcare, but for AI, I guess related. I think a lot of people are excited because there's so many inefficiencies from what I've heard just in the healthcare sector. So I think that's an area that could eventually see a good boost from AI, but then also like with blockchain, using AI to help with like with companies that might have like just say like there's an outbreak in some sort of food product, and you can use blockchain with AI to sort of identify that problem, isolate it fast, and not have to spend all these resources trying to identify it, and you can just save a ton of cost doing that. So I think that's something that will eventually, and I think it's starting to happen a little bit, but there's just a few areas that I think we'll continue to see flourish.
So I think some key risks, what I'm learning from our conversation today for 2026 is be over concentration into mega cap tech in our portfolios, or your portfolios as listeners. Valuation compression if rates continue to stay higher longer, or I guess the way to say that is the Fed does not cut rates in line with market expectations. That could make the market trade downwards. Obviously, you have the black swan event. So anything that happens globally that we don't have on our radar, that could trigger a market reaction. And then election related volatility. So people concerned about these midterms that will be coming up, and which way the which way the pendulum swings in that. So as you mentioned earlier, that could be, sometimes it's the weakest market years or the ones in the middle. I go back to I don't know that if you look at every presidential election or every presidencies and you look at midterms, yes, it can be weaker, but also it can be stronger.
Right.
You go back to Clinton in office, those are some of the stronger years were in the middle years, if I remember correctly, partially because Newt Gingrich's New Deal, right? And so the government had checks and balances again, not as much was getting done. And so sometimes the market will run when it goes, oh, they can't do anything. They're stymied. So the market will just take off.
The market likes the checks and balances. And so if there was a Democratic Congress that was elected, the market might reward that. So, but again, there could be some volatility leading up to that. I think another risk that we haven't really talked about is potential for more inflation risk. And that's really coming from stimulus. We've hear proposals of a tariff dividend to a certain class of people. There was the Warrior dividend that came out in December. So that it should drive consumption and growth, but also drive inflation. So I think they need to be careful about some of the stimulus as well.
Makes sense. So what are some actionable closing points that we should be looking at in our portfolios for 2026?
I think, again, for me, it's just, are these outperformance trends big paradigm shifts? And that's something I'm continuing to assess. Again, I look at things, I might write a blog on it, but I still continue to monitor it and evaluate it. So it just, are international equities going to outperform US for the next 5-10 years? Or does the AI still have, AI tech companies still have legs? So it's just something that I need to monitor and continue to just assess whether that is a long-term sustainable trend. But outside of that, we like having in our equity portfolio and a quality, I hate to say tilt, but just exposure to like quality growth or quality stocks. We have a fund that focuses on free cash flow growth, and the thesis behind that is they like the highest paying free cash flow in companies because those companies can then reinvest that cash flow in higher returning projects for the companies, or they can pay that back out to the investors in dividends or share buybacks. So we like that because usually in down markets, that fund will hold up better, and that quality exposure holds up better in down markets. It does lag a little bit in up markets, but again, we're looking at a risk adjusted return across all market environments. But that's something that we like to continue to have in our portfolio. Again, I think just some other themes. I think small mid caps will probably get a boost and a little bit of a relative outperformance. I don't know if it'll be like 15% like international ones this year, but I think there'll be some periods where those stocks will do well. And I think also just digital assets will have a recovery. There's a lot coming down the pike with just more regulation around the space, which is what was needed. And then also just institutions like Morgan Stanley, Wells Fargo. I'm missing one, but they're starting to offer the Bitcoin and other major cryptos to their clients like just now. So like all that client base and investor base is going to get access to the digital assets. So there's a lot of institutional adoption going. So I think we're just going to continue to see demand there.
All right. Any final statements?
I think we've covered it. I think in a nutshell, we're going to have another, I do believe we're going to have another mid-single digit year or more in US equities. Given unless there's some unforeseen catalysts that we can't predict.
Yeah. So Sean and I are on the front lines as we meet with clients and do review meetings. And I would say that these are always fun conversations to have, kind of nerdy conversations, to get in the details of portfolios. But the 1 year, no matter what happens, doesn't really matter.
Right.
It's focusing on getting you to age 95 without running out of money. And you're going to have some ups, you're going to have some downs. but a good diversified portfolio is going to hold 6,700 stocks, probably 12,000 bonds. And you're in some sense, you're along for the ride, but you can make tweaks along the way.
Right.
And that's what Andrew's really good at, is hitting rebalancing periods at just the right time, trying to stay out ahead of what matters for the next 10 years. For instance, if we were to shift more to international, it's not because we had international was good last year. That's an amateur move. We'd be shifting because we think over the next 10 years, this is a pattern that's going to hold up. And so that's why we have a portfolio manager, well-educated portfolio manager here to help us make those decisions internally. Because honestly, as the business owner externally, it's a bunch of marketing and flashy objects and
the fire hose.
Yeah, it can be a fire hose at times. And so if you depend on outside sources fully, they're trying to twist you to sell their widget. And so this is why I like doing this internally, where we don't have those kind of pressures, and we can make our own decisions.
And we have someone or a team dedicated just to that while we're meeting with clients, and you're running the firm. We're meeting with clients. We have, Andrew really looking out for us and the clients and looking at the details all day long on this.
Absolutely. Doing great, Andrew. Thank you.
Thank you.
All right. So this is something we're doing. We haven't done it, I think, in a few episodes, but we're doing 3 questions in 3 minutes. Andrew hasn't had his turn yet. So let's have a little fun here. And at the tail end, what's one money mistake that you're weirdly glad that you made, Andrew?
I am weirdly glad that I, made the mistake of investing too conservatively when I first started investing. It really kind of got me to, I invested in CDs and just sort of risk-free assets. And when I first started out in my career, when I wasn't in finance, I was in construction actually. But then I realized that inflation was higher than the yields I was getting and the interest rates I was receiving on those investments. And I was like, wow. And that just kind of really got me more interested in learning more about, investment analysis and understanding risk a little bit better. And so that kind of like led me to go, okay. My passion was to be in finance. I graduated in 2008, took the best offer at the time I had. Right. So I decided to quit my job, and then I landed an internship at my previous employer, and was there, but that sort of gave me the passion to just learn more about the investment side of things.
So we're grateful that you were very conservative. You wouldn't be here otherwise, right?
Yeah, exactly. If you could only travel to one place, where would you go, and who are you taking?
That's a loaded question. I mean, being in the aviation industry, I feel like you probably get this all the time. I know my wife's a flight attendant with Delta, and everyone always asks her. If I had to pick one place, I would say the Maldives with my wife, because we had always talked about going. And then basically ever since we've been married, we've basically just been in kid mode, and we just have not been able to take a trip like that. So we've talked about maybe for our 10-year that we would do it, but it's probably going to be tough to do that. So I guess if there's one place that I'd pick, it would be the Maldives with my wife.
Just take all 5 with you, and you get a hut just for them. They have nannies there, right?
That's probably
that doesn't sound like a vacation to me.
That's probably like 10 years of salary.
All right. So what's something that you strongly believed 10 years ago that you don't believe anymore?
So I had to think about this one. So I don't want to come off as this being political or anything. To me, it's that institutions aren't infallible. And I'm really mostly talking about the medical professionals and the media. And I think obviously you could point to COVID for a lot of that, pointing to both those industries. So, now, and not that I wasn't before, but now I'm just really more skeptical. I've seen things personally, just like with my kids being sick, that they're trying to recommend a certain, treatment to something where it doesn't make sense. And that they're not really just, not necessarily know it all. So I think it's good just to be open-minded and not be just in a box necessarily, and just be more inquisitive.
Yeah, that's really good. I've had some medical experiences in the last 10 years that kind of opened my eyes. It was like, wait a minute. Like, and then I started doing more research. It's like, how do you know all these people are actually smart people?
Right.
Yeah.
Yeah, and as far as media go, I feel like I try to, even with my political biases, I try to get counter, and also just portfolio biases. I try to get counter opinions to that to try to ground myself. And I try as much as possible to do that.
Yeah, we had a situation with my mom where they told her she would never walk again. And it's like, no, this is not right. And there was a doctor in Rome, Georgia that was like, what? No, we're just going to do this one quick procedure. She'll be fine. Yeah. And she was fine. She is fine. So you're right.
It's like overcomplicate.
You're just like, what? It's like, what is it? Yeah.
Well, that's a blessing that you don't know
which doctors
opinion.
got C's on the exams and which ones got A's. That's all I'm saying. That's all I'm saying.
Or how long a nurse is, like when did she graduate or whatnot. So
exactly. Anyway, that could be a whole different podcast. All right. Well, thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management and want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can click on the episode notes. We'll see you guys next week.